Chinese central bank has about 4% of its reserves that could be fake gold. So you're not talking about retail investors or any investor who doesn't understand gold. It is the Chinese central bank also likely to have impure gold in their holdings. So this is unprecedented in some way, and the magnitude that we're talking about is really large. And it's not only in the global markets or in China, even in India, there have been fake gold bars, machines that manufacture those gold bars seized in right in the heart of gold market, that is Zaveri Bazaar, right? So there are unscrupulous elements that operate also in Indian markets. Like we know that smuggling in India is rampant yearly because of the differentials that we have with international prices. There is estimated about 100 tons of gold being smuggled into India. And there have always been question marks. People talk about hallmark, but still there are question marks surrounding, is the gold jewelry, even if it is hallmark, is it genuine or not? We have seen fake stamps being put on gold jewelry as well, and that is not genuine gold. That is really impure gold. And time and again, because there is no onus so far, and the strict implementation of hallmarking scheme hasn't been there, and therefore even when it's kind of a quality hallmark gold, but it turns out to be huge quantities of impure gold. So as I've said, smuggling is happening, or illicit gold imports happen in India. We have seen so many seizures happening at airports, railway stations, etc. Because gold comes from abroad without paying duties. Today, custom duty in India is 12.5%. So, and GST, which is 3%. So all in all, there is a differential of 15.5% between Indian gold prices and between the international gold prices, that is taxes and duties. And this is good enough margin or a rich margin for anyone to try and import smuggled gold into India. And therefore, whenever you get such large quantities of smuggled gold coming in Indian markets, it's always prone to impurities. So whenever you buy physical gold, you need to keep this backdrop into consideration, because what you could be buying could be smuggled gold and therefore could be prone to impurities. There have been surveys by like World Gold Council or BIS, Bureau of Indian Standards, which have time and again brought this point into limelight, right? Many investors, up like 48% of investors and 28% of jewelry consumers in a recent survey in 2019 have said that there is a concern when they buy gold of purity. There could be mistrust around fake or counterfeit coins and bars, and also when they buy jewelry. So there are concerns that investors have always had. India continues to buy good quantities of gold. It's the largest consumer of gold. But still, despite people going and buying out, they are concerned about the purity of gold that they're buying, right? There is a refiner called MMTC PAMP, which is only LBMA accredited refiner in India, and they also refine a lot of scrap gold. And they have found that 15 to 20% impurities in gold that they refine. So it's right coming from the horse's mouth saying that, yes, there are impurities when they refine old jewelry or scrap gold as it is called. So time and again, there are concerns on impurities, and there are valid concerns because it is in actual impure gold or adulterated gold to the extent of 15 to 20% that we have found. So rightfully so, investors will want to know, given that they are investing in gold for the long term, when they try to realize their long-term investment in gold to fulfill their goals, whether the gold they own is pure or not, or whether at the end, when they want that money from gold, whether they will find out whether that gold is pure or impure and therefore have financial loss. So probably that's what the vaulting agencies tell me, that we are the only gold fund. Quantum Gold ETF is the only gold fund that takes purity test of the gold held by the fund. There is no other fund house that probably does purity test of the gold that they own. How we do it, we'll come to that in very detailed manner going ahead. So first, what kind of gold we take for the quantum gold fund? When you invest with us, what is the kind of gold that we buy? It's 24 karat gold, also known as 995 fineness, meaning 995 out of 1,000 parts is pure gold. And that is sourced only from LBMA accredited refiners. LBMA is a global authority on precious metals. They have stringent checks and balances on the refiners that refine gold or produce gold, and therefore we only have satisfaction buying LBMA gold. No other gold, not even Indian refined gold, or be it gold coming from any other non-LBMA accredited refiner like from Middle East, we will not buy that gold. So usually gold that we get is from either Switzerland refineries or be it South African refineries. These are the two predominant places from where we get gold, or sometimes from Australian refineries. Gold, each and every bar is accompanied by a refiner's certificate that gives us the authenticity or the purity of the gold that we buy. And there is a serial number that is there on the certificate and the gold bar. We only import gold, buy gold that is imported through authorized or banking channels. Our gold is stored in professional vaults, and these are world-renowned professional vaulting agencies like Brinks, where we store our gold. And whenever gold is produced by the refiner, it has to have a trail of gold where it has moved. And anytime if it has moved out of the custody of the vaulting agencies, we do not buy that gold. Even for 1 second, it has left the doors of the custodians or the vaults, we do not buy that gold again in the fund. So that is the kind of mechanism that we have. And it is very, very important to know where the gold has traveled, to which entities it has moved, through which vaults it has moved. And the vaulting agency gives us the indemnity of, or a certificate that tells us that it has never crossed their eyeballs. So it has always remained in their custody at all times, and it has never left their custody. So there are various documents that establish a trail of gold, like the customs invoice, the bill of entry, the master airway bill, the purity certificate. So we know which entity have owned that gold before and where it has traveled so far. What we do in terms of checking that the gold is always there in the vaults, there is an audit done by statutory auditors twice a year and monthly by the custodians of the fund. Quantum team every month, led by the fund management team, goes to the vault to check each and every bar held by the fund. We don't not only rely on the audits, but we ourselves want to make sure that the gold is always there. And therefore, we go to the vaults every month to ourselves check each and every gold bar. And when you take that gold bar in your hand every month, I've been doing that for 12 years in a row every month. And that really tells me and kind of I can easily touch and feel the gold bar to see if it is pure or not. And that's not all. We do more things to ensure its purity, which will come through that later. And we cross-check and verify the marks on the gold bar, which have to be there to prove the authenticity of the gold. That is what we do in our every visit at the vaults. These vaults are very, very secure vaults with armed guards, with all systems and mechanisms in place. So there is walls which are iron proof. I mean, there is iron sheets there in the wall, in the walls. Also, there are alarms, panic alarms, and various different gadgets to ensure the safety of the gold. And despite that, all the gold held by the fund is completely insured. even it includes terrorism cover. So it is a comprehensive insurance policy that we have for the gold that is owned by the fund. So no compromises, it's safe and secure. So as I have said, we are probably the only fund in the country to do the purity test of the gold, of the entire gold holdings that we have. And not once, we have been doing for years together. Every year we will hire a professional testing agency who would come to the vaults and check the purity of each and every gold bar that the fund owns. So and each and every year we have found that all the gold bar satisfies the purity that is mentioned on the gold bar or on the certificates, and each and every gold bar is certainly pure. So this is the biggest advantage that we as Quantum bring to the table, given that we are not assured just because we are buying LBMA gold. We go steps ahead to ensure that what we own is certainly gold and nothing else. So that's the big differentiator, according to me, and that gives us a kind of a mental peace that we are fulfilling our fiduciary duty that we own to our investors, and we haven't skipped even a single step, though we have to incur cost towards doing such test, but we believe it is our fiduciary duty to do that. So this is, I hope that this makes you more comfortable if you're owning gold in the Quantum Gold Fund, saying that it is safe, secure, and pure. Whatever gold you have with us, it's gold for sure. Given that we have shown you how we protect or safeguard your gold, I'm sure investors will want to know whether should we have an allocation to gold and how much, and what is the view on gold prices. So let me take you through a few slides that showcase that. So asset classes like equities, bonds, gold go through cycles. So we have seen many times equities doing well, sometimes bonds doing well, and sometimes gold doing well. And if you ask me, predicting next year which could be the best asset class, it's kind of you could have a guesstimate, but it's far from perfect, right? And therefore you need to own have allocation to all asset classes, because each asset class plays an important role, and so does gold. Gold plays a very, very important role in your portfolio in terms of stabilizing your portfolio returns, especially in times of stress, when there is like the COVID episode, for example. If you see, we have seen a significant fall in equity markets when COVID hit us. And that is the time gold helped your portfolio in terms of stabilizing returns. When equities were like down 20-25%, gold was up like 40-45%. So that really helped you to stabilize your portfolio from if you're looking from a 1-year return perspective, those were the returns that you had. And time and again, like in 2008 or any of the crises that we have seen, gold has certainly done well. And therefore you need to have an allocation to gold. Like this chart shows you, gold is like the third leg of the stool that gives stability to your portfolio. Time and again, when equity markets have not done well, gold has done well. And if you see overall, out of 40 times, 16 times gold has done better than equities. And that really tells you that a third of the time, approximately, gold has done well and helped your portfolio. And therefore, it is like the third leg of your stool, that you have. It helps in stabilizing the portfolio and reducing the risk when it counts. This also shows you that if you add gold to your portfolio, it not only augments returns, but also lowers your risk significantly. Like if you see long-term returns from gold are comparable to other asset classes or better, and risk is lower. And when you include it in the portfolio, if you see the portfolio A on the screen, equity, debt, and gold, if you see, returns are comparable to equities, slightly lower. But if you see the risk in terms of the drawdown, whenever there is a big sharp fall in equity markets, equity had a biggest fall of 56%, whereas a portfolio of equity, debt, and gold had fallen only by 21%. So inclusion of gold helps you reduce that drawdowns, doesn't compromise on returns, and reduces the risk. And this chart again shows you the comparable returns of different time frames vis-a-vis other asset classes. Gold returns are indeed comparable, slightly lower, but it also comes with lower risk and counts when your other asset classes are not doing well. One thing that you always need to keep in mind is that your cost of living keeps increasing year on year. Like in 1990, you need to pay 23,000 rupees to buy the annual consumption basket for your family. Today, that same consumption basket, the same things you need to buy, costs you 4,27,000 rupees. So that has increased by about 10% per year. Price of gold has increased by about 9% per year. So it's more almost matched your cost of increase in terms of your spending. And gold has helped you kind of maintain your purchasing power. Of course, equities have helped you, but equities at the end of the day have been very, very volatile. And therefore, if you invest in equities, you need to have an allocation to gold, because time and again, when equities have not done well, gold has helped your portfolio. Coming to gold, why gold? This chart tells you all that currencies continue to be debased by central banks. Governments continue to run deficits and issue more debt, and your value or purchasing power of your currencies go down. And gold helps you to maintain that purchasing power. So in gold terms, most of the currencies, be it US dollar, be it INR, have lost more than 90% of its value. If you see in 1980s or 1970s, rupee was around 7 rupees, and today it is 75 rupees, right, to the dollar. If you had in gold, uh, gold has helped you protect from that rupee depreciation significantly, because in gold is measured in rupee terms, or if you see Indian rupee has lost about 97% of its value when measured in gold terms. And coming to the outlook on gold, why gold now? If you see, there have been, because of COVID, uh, growth projections for this year have gone down significantly. For global developed economies or for emerging market economies, we are staring at a very low growth this year. This year is going to be a washout. Even next year, many are saying that it's going to be a very sharp V-shaped recovery. It's kind of not necessary that we will see a V-shaped recovery. Time and again, when we have seen that when there is a debt overhang, to get a higher growth rate becomes that much difficult. And I think it's going to be slow, gradual recovery. Initially, it may look like a V, as we are seeing now to some extent, but post that, it's going to be a slow, gradual recovery that we may see at best. What have central banks done to support economies because of decline in growth? They have cut rates aggressively, and in many places we are seeing low to negative rates, interest rates, even on a nominal basis. So whenever you have these negative interest rates, being in fixed income instruments till maturity ensures that you will lose money on a real basis, right? And therefore there will be shift from these negative yielding fixed deposits or fixed instruments towards instruments like gold, because there will be some inflation, because we have seen significant amount of money printing from central banks, and therefore people will shift to preserve their purchasing power from these instruments to instruments like gold. Whenever we have seen a negative interest rate on a real basis, what does that mean is whatever is the interest rate minus the inflation gives you the real interest rate. Even in the 1970s, when real interest rates were negative, as shown in the chart on the left side, gold had a big rally. Even in from 2007-8 till 2011, we had seen the same negative in real interest rates. and gold had a huge rally. And so is now. And this time, because the economies were badly hit, these central banks will continue to remain accommodative for fairly long time. Even after 2008 crisis, as they started doing quantitative easing and being in an accommodative stance, they continued that for about 6 years. And this time, we all know that crisis is much more severe, and therefore they will be much more accommodative. They will continue to undertake unconventional policies and print more money. So if you see, central banks are really on a printing spree. If you see the chart, the blue line on the left side, that has gone significantly vertical, right? It's like money printing gone nuclear. They have been printing significant amounts of money, and overall, central banks have become a large chunk of the economy now. Central banks make it possible because they print money and buy the debt that the governments issue, therefore making the debt issuance possible. Many economies like US or Japan, they have 30-40% of the debt issued by the government, owned by the central bank. So central bank prints money and buy the debt issued by the governments. That is really a recipe for significant currency debasement, because without a captive central bank, that wouldn't have been possible. So we are seeing currency debasement on an unprecedented scale, and that is likely to continue, and therefore that will support the gold prices fundamentally. And we are seeing significant increase in debt to GDP ratios. Debt across governments have been increasing. Debt to GDP ratios are increasing. And whenever you have such high debt in an economy, the growth usually is not so robust. You can't have very high growth rates when there is such a large overhang of debt in the economy. And because of COVID, it's been significantly larger at all levels, be it the government level, be it the corporate level, or be it at the individual level. So this debt overhang will mean that growth will be shallow or tepid, and therefore central banks will continue to remain accommodative. Gold, one of the reason that you buy gold is also because of the currency depreciation. Like you've seen over a long time, rupee has depreciated against dollar by approximately 5% per annum. So that is one additional factor that helps Indian gold price. And when you're an investor in gold, that is another add-on factor in terms of returns. So where are gold prices headed? So gold prices, as I've said, in Indian rupee terms, are a combination of where the dollar gold price is going and where the rupee is going. So as we have explained that gold price look fundamentally more positive, more constructive. So today we are at $1775 an ounce, and given the factors, it could inch up going forward. So wherever you see the gold prices going, maybe 1800, 2400, 3000, we have predictions from various global houses on these various levels. And rupee, in our view, is likely to depreciate going forward, given the factors that we are seeing. And if the growth doesn't come back in India, there could be huge selling from foreign investors, and that could accelerate the depreciation in INR. So wherever rupee goes and wherever the gold price goes, that will determine the INR gold price. For example, if the gold price were to go to 2400 over next few years and rupee go to 85, that could translate to about 75,000 rupee gold price in INR terms, 75,000 rupees per 10 grams. So it is just a combination of where the rupee is and where the gold price is. So what's the best way to own gold? Gold coins and bars has various problems in terms of, firstly, on the purity, and then there are markups, there are buyback issues, there are discounts that come along with it. So that's not an efficient way to buy gold. Gold stocks, please remember, gold stocks are stocks first and gold second. If you see the long-term returns of gold stocks and gold, at times it is comparable. And at times we have seen like a 10-year return of gold stocks or a stock fund vis-a-vis pure gold. We have seen a significant difference between them. And whenever the stock markets fall, gold stocks fall along with it, no matter if the gold is rising or falling. So it doesn't move in tandem with gold, it moves more in tandem with stock markets. Gold futures are highly complex. Sovereign gold bond gives you the gold price exposure. It's backed by government guarantee, but there is no gold backing to it. And I think gold ETFs or gold funds are the best financial innovation that we have seen over the last many years, because it allows you as a retail investor buy lower denomination gold at prices at which tons and tons of gold get exchanged between, say, a gold producer and a bullion bank. So that is the kind of efficiency that the gold funds bring from a wholesale level to a very retail level. And there are no issues of purity because the fund house takes care of it. So as you have said that sovereign gold bond from an arithmetic perspective, like a return perspective, it looks better, but there is no gold backing. And people buy gold because they don't trust the system in a way, right? And therefore they want that pure gold exposure, not a guarantee. Gold is no one else's liability. And with a sovereign gold bond, you in a way are making it a liability of the government. So according to us, there are various, there is a case for gold ETFs. According to us, it is efficient. You can buy lower denominations, and mainly it is regulated by a regulator like SEBI. So if you want to go invest in gold today, I think Quantum Gold Saving Fund is an efficient way for you to buy gold, because you don't have to worry about purity. You can do lump sum or SIP investments, no hassles of purity, storage, insurance. It's all taken care by the fund house. You could do SIP, and more importantly, it is open 24/7. I have seen many approach me during the lockdowns because of the crisis. They wanted to sell physical gold, and they were not able to do that because of the lockdowns. And if you had investment in the gold saving fund, you could easily sell it within a second, and the money would come to your bank account. So it was not hampered by lockdowns. You could buy, you can sell even during such kind of lockdowns. So it has proved its worth vis-a-vis physical gold, and they are virtually open 24/7. So invest in Quantum Gold Saving Fund because it's indeed an efficient way to buy gold. With that, Ghazal, I will pass it over to you.
Sure, Chirag. Thank you.
Thank you.
Thank you so much for your presentation. The main takeaway here for our viewers was gold's role in any investment portfolio today and for the times to come. Also, it is clear to us now that holding physical gold, it is going to be prone to impurities, and therefore a more efficient way for investors to invest in gold would be through financial avenues like gold ETFs. Now, before we move forward, we have a very unusual guest with us. I say unusual because no other mutual fund has done this before. Mr. Malay Vora, Head of Compliance at Quantum Mutual Fund, is here today. He's joining us to personally assure our investors about the purity of gold held by Quantum. So, Malay, very happy to have you here. Over to you.
Thank you, Ghazal, and good evening, everyone. As Chirag said, in the Quantum Gold Fund, the gold is safe, secure, and pure. And I'm as a part of the guest speaker just to ensure, whatever the Chirag says, that's perfectly fine for that thing. So if you see for that thing, the first things there is a stringent delivery norms when there is a gold is purchased, whether there is a finance is there or whether relevant documents is available, refinery certificates there. At the time of the purchase, that has been ensured. Even if you see these things, the gold is whatever the gold held in the gold fund, you can see also on the website where there is a monthly portfolio is disclosed. So even if I can see in one of the question in the chat box, in that say case, what is the how much kg bar is there. So as of May, there are the 178 bars of the 1 kg bar we have in the gold, and also 200 bars of the 100 grams. So that detail is there, and that detail is disclosed on the website also is a part of the monthly portfolio sent to the investors. So you can anyway check from the any times, which gold a number of bars held in the scheme itself. Also, there is a verification. There are the three independent verification done. One is by the quantum team, which comprise of the fund manager Chirag himself. One there is from the operation guys and other from the risk teams. They go and verify independently every month. In addition to, there is the auditor, which is not appointed by the quantum mutual fund, but that is appointed by the custodian. So that they verify with all the documents whether there is actual gold is there, meets the requirement. And this is the specifically they do audit for the quantum fund. So there are many mutual fund gold will be there, but they check only for the quantum things and they give the certified for the quantum for that things. Other thing, there is a requirement also for the statutory auditor, which is requirement as per the SEBI. The statutory auditors to verify the gold in the vault for that thing, and they need to provide the certificate to the trustee for that thing. So it will ensure that there is actual gold that is there in the scheme itself. And last not the least, but basically the trustee has the fiduciary responsibilities toward the mutual fund. So requirement from the SEBI point of view, trustee also will give the confirmation half yearly to the SEBI. There are the actual that there is a gold in the gold scheme. It's invested as per that asset allocation, and there is actual gold holding verification is there. And also the Chirag said for that, there is a purity test. It's done by the quantum mutual fund. And this purity test certificate is also that if you can see our annual report of the quantum mutual fund, you can see that purity certificate is a part of the annual report for that thing. So I think as a part of the compliance, so, we can just, I think the investor can rest assured that okay, the gold held under the quantum mutual fund is completely safe, secure, and pure for that things. Thank you. Over to you, Ghazal.
Thank you, Malay. And thank you, Chirag, both of you, for assuring our investors about the robust processes and the purity of gold that is underlying the quantum gold ETF. I'm sure they'll be more than confident now when choosing the quantum gold ETF for their investments. It's time now to take some questions. If you haven't sent your questions across yet, please do send them to us. Chirag, the first question for you. What process do you adopt in case you have an instance of not achieving success during a purity test? And what do you do in this situation? This could be taken by Chirag or Malay, either of you.
Sure. Just to begin here, when Malay can join in. So in an instance where the purity of the gold is not matching what it is stated, then we have recourse to refiners. We have recourse to from where we have purchased. There are agreements in place that we have, and therefore that allows us to have a recourse up to the refiner in case the authenticity of the gold is not up to the mark. So far that hasn't been a case. We haven't found that during purity test we have found any gold bar not meeting the purity requirements. But in case we have recourse to counterparties. We have recourse up to the refiner, as I've said, and there are agreements in place because we buy only gold through official channels, through authorized dealers, and each and every with each and every counterparty through whom we buy gold, we have those agreements, and the vaulting agents certify or indemnify that the gold has never gone out of the custody. That helps us to go after from where we have bought gold and try to ensure that they replace the gold that we have.
All right, thanks. The next question is, can an investor take delivery of physical gold through the gold ETF?
Certainly, given that the gold ETF owns physical gold, if you are an investor, so the fund buys on your behalf. So when you buy gold, buy the quantum gold ETF, that is where the gold is bought. So each and every unit is backed by gold. And given that it will be just a change of form from units to gold, and therefore you can certainly change that and have physical gold in lieu of units that you have. But only constraint here is, given that we participate in the wholesale gold markets, and therefore the gold that we can give you is minimum 1 kg gold, because we buy and sell 1 kg gold bars. And therefore, if your units are equivalent, which will be 2,000 units of the quantum gold ETF, you can certainly come to the fund house and take delivery of gold.
All right. Next question, Chirag. What are the expenses involved in having the gold ETF annually? So what are the expenses to the investor?
Sure. So if I were to break the expense, the biggest expense in the gold fund is storing of gold and insuring of gold. That is one of the biggest costs that we have, and we will not compromise on the insurance that we take. So the insurance that we have also includes terrorism cover. So there are various insurances available, but we have opted for the most comprehensive gold policy, and therefore that comes at a slightly higher price. So overall, the expense ratio of the quantum gold ETF is 0.97, and as 0.97%. And as the assets of the scheme increase, we will surely decrease that expense ratio. So currently, the bulk of the expenses are storing and insurance of gold, which goes towards paying the custodian. And secondly, there are R&T and other charges which are smaller, but they also add up to the expenses.
Okay. Chirag, for the benefit of our investors who are not very sure about this, can you please differentiate between the quantum gold fund or the gold ETF and the quantum gold savings fund?
Sure. So quantum gold ETF is an exchange traded fund which is listed on a stock exchange and trades like a share and moves in line. The prices move in line with prices of gold. So like you would buy any other stock, you could buy the quantum gold ETF through your broker. So each and every unit, 1 unit of quantum gold ETF represents about half a gram of gold, and you could buy 1 unit at a time, which is be approximately half gram of gold. And that you'll need a demat account compulsorily to buy the gold ETF. Given that they trade on an exchange, it will come into your demat account. Whereas if you see the quantum gold saving fund will invest in the in the gold ETF. The gold ETF will buy physical gold. Gold saving fund will buy gold ETF. And therefore, if you even if you don't have your demat account, you can still buy the quantum gold saving fund, which is kind of a wrapper around the gold ETF, because it will invest almost 100%, 99-100% in that range into the gold ETF, and therefore gives you that same exposure at a very nominal cost. So there is an expense ratio over and above the expense of the gold ETF of 0.05% of buying the gold saving fund. But apart from a long-term risk and return, it will almost be the same in both. But if you're an investor not comfortable buying through your trading account or through your broker from the stock exchange, you can buy the gold saving fund. So if you don't have a demat account, if you want to do an SIP in gold, the gold saving fund is helpful. But as I've said, from a risk return perspective, both over the long term will give you similar returns and risk.
All right. How does a gold ETF liquidate if there is redemption pressure, and who buys it?
So the beauty of gold ETF is it translates the liquidity of the gold market because the underlying being physical gold. So there are bullion dealers who would buy the gold in case of redemption pressures. So the mechanism, the way it works is there are authorized participants or market makers which the fund has appointed, and we have an agreement with those market makers to quote or provide liquidity for the gold ETF that trades on the exchange. So in case any redemption pressure, we could sell out in the gold market, in the wholesale gold market, and get the rates, ongoing gold rates. And that wholesale market is very liquid. And we have some renowned bullion dealers who are market makers for our gold ETF. So getting the liquidity for any quantities has not been a problem so far. And I don't think, given the fungibility that the gold ETF has with physical gold, there shouldn't be any problems of liquidity.
Okay. Do you buy gold based on the investor's requirement? That is, as in when the unit holder puts in money, or is there a frequency when it's collectively bought?
So as and when there is units being created, there is gold that comes first. So how it works is these authorized participants that the fund has appointed, they will sense demand on the exchange, and they will create new units by giving the fund gold to that extent, and take units from the fund house. Also, uh, there is a possibility that the gold saving fund has significant flows, which it gives to the gold ETF directly, and the gold ETF will procure gold from banks or authorized dealers, and and create more units to give to the gold saving fund. So yes, in all cases, uh, whenever the money comes, units are created by only by having underlying gold first, and then whoever is the investor, the units are transferred to them.
Okay. Why are all these payment wallets suddenly selling digital gold? How is digital gold different?
So digital gold has also offer you smaller denominations by micrograms of gold as and when you want to. But the biggest difference between these digital wallets that offer gold vis-a-vis the gold ETF or the gold saving fund is uh, gold ETF and gold saving fund are regulated products. They are regulated by SEBI, whereas these digital gold offerings are not regulated by any other regulator. So that is one of the biggest difference, as we have seen in many like there are chit funds, or there are various schemes offered by dwellers, and we have seen time and again some issues with those because they are not regulated by any entity, whereas gold saving fund and gold ETF are regulated by a regulator like SEBI. So that is the biggest advantage that gold ETF and gold saving fund bring to the table, plus the stringent norms that we have. I'm not aware about the norms that they might have, but I'm very confident on the norms that we have for the gold that we procure. So that could be additional difference. Plus the audits that we have in place in terms of the statutory audits that SEBI mandates us to have, the custodian audits, the just checking that we do from our side, the insurance of gold that we have. I think all those could be a big difference in terms of customers or investors' comfort in when it comes to the gold that they have. So I think that is regulation is the biggest difference between both. And there is one more element that differentiates or gives an edge to the gold fund or gold ETF, that is GST. If you see, when you buy digital gold, you pay GST. When you sell digital gold, you don't get back that 3% GST. So there is a loss of 3% if you buy and sell digital gold. But when it comes to gold ETFs are pass-through vehicles, and we have a GST registration, and therefore, whenever we buy gold, we pay GST, and whenever we sell gold, we get offset of the GST that we have paid, which we pass it on to investors. So investors don't lose out on the GST benefit that the fund house transfers to them, which the digital wallets do not. So two main differentials: one is a GST loss that they face in digital wallets, and second is regulation.
All right. Um, Chirag, what distinguishes one gold ETF from another since they all invest in the same asset?
What distinguishes one gold ETF with the another is one is most all gold ETFs have gold underlying the units that they create. The biggest difference is what kind of policies that the fund house has. I have shared you our policies, which are very detailed. Uh, if the investor wants, they can also take physical gold delivery from us. But I don't know the policies of other fund houses in terms of the safeguard policies that they have in place. I mean, the purity test, the vaulting guys tell me when we did it for the first time, I think it was a few years back, that they had seen this happening for the first time. And even now when we go there, they say that you are the only guys who do such kind of tests. So I think that is the biggest differential between gold ETFs. But otherwise, from these, the policies that the fund house has towards safeguarding the gold, that is the biggest differential between the gold ETFs. Otherwise, most of the gold ETFs are available at lower different denominations. Like quantum gold ETFs is available at a ½ gram denomination. There are some ETFs who are available at a 1 gram denomination, and some ETFs available at lower than ½ gram denomination. But apart from that, you need to check what the policies each fund house has and how comfortable you are with those policies.
Thanks, Chirag. What is the return for the Quantum Gold Savings Fund, and is it a good time to invest in gold now?
So returns from the Quantum Gold Saving Fund are on your screen. 1 year return have been significantly higher because gold has done well in that time frame. Long-term returns have been in line with gold, barring the difference being the expense ratio largely and some tracking error. But apart from that, the returns will be in line gold. And what gold returns will be, we have already explained that the outlook for gold looks constructive, looks positive. The factors over the long term look significantly better for gold price to inch higher. And and I think the returns is just an icing on the cake. I think the main essential reason that one needs to own gold because it is a useful allocation in one's portfolio. It helps you not only augment returns, but it significantly helps you to lower your portfolio risk. And that is the reason you need to have an allocation to gold, especially in times of stress, because episodes like COVID or some financial crisis, since 1994, we have seen about 26 dislocation or 26 years, we've seen 17 dislocations in equity markets. Equity markets have fallen sometimes for reasons that were visible and sometimes for reasons like COVID, which are not predicted by anyone. And most of the times when stock markets have suffered losses, gold has helped you to minimize those losses from a portfolio perspective. And therefore, you need to have an allocation to gold. Returns from gold look positive, but don't just look at returns. Look at the essential role that gold plays in your portfolio.
Okay. Chirag, how does the expense ratio of Quantum Gold Fund compare with other gold ETFs?
So if you see gold ETFs expense ratio have been, there's a wide range because there are about 11 fund houses offering gold ETFs. So we have seen expense ratio from about 0.6% to about 1% in that range. So our expense ratio is 0.97 at this point in time. And as I've said, we have a roadmap for the expense ratio going down. So as and when our assets keep increasing, we will reduce the expense ratio. We have already given that roadmap out to investors. So even before most of these fund houses lowered their expense ratio, we had given that roadmap to investors that as we inch up in assets for the gold ETF, we will reduce our expense ratio significantly. And we will continue to do that in the interest of investors.
Chirag, can gold ever fail as a hedge? If yes, under what circumstances?
So gold, I mean, you're talking about, there are two ways in which people look at gold as a hedge in a way. One is looking at inflation, and second is looking at the stock markets. So there have been times, a couple of times when stock markets have also gone down and gold has also suffered, but those periods also saw losses in gold were not that high. So uh, like for example, years like 1996, when gold was down and even equities were down, but both were not down significantly. We have seen, like in 2015, gold was down -6 and equities were down -8. So there have been times when both have moved in tandem, but those were very, very short episodes or following a significant rally in gold markets or something of that sort. So most of the times, as we've seen on the screen, a third of the time, whenever stock markets, it has outperformed stock market a third of the time, right? And most of those times were when equity markets had suffered heavy losses, right? So from a stock market perspective, we have seen time and again, gold does well. And whenever stock markets have fallen, a major role has been played by foreign investors selling. And whenever foreign investors sell, rupee depreciates, and that adds to gold returns. So that is in a way a self-fulfilling theory, and therefore, whenever stock markets have fallen, gold has kind of helped in terms of offsetting their losses to some extent. And inflation, we have seen sometimes it may not keep pace like to like with increase in inflation, but it catches up. And over the long term, as we have seen in this chart, it has helped offset losses over the long term period. Like from 1990 to 2000, inflation went up from 23,000 rupees per annum spending to 68,000, whereas gold didn't do that well, right? It just went, you needed 70 units of gold, and then in 2000, you needed 152 units, much more gold to buy that the same consumption basket, right? So it may not during some time periods when there is inflation, because inflation will keep ticking up. Gold being an asset will have periods of bull market, of a bear market, but over long time periods, it will kind of stay true to its properties, which is being a store of value.
Thanks, Chirag. This is a very interesting question here. How do you protect gold bars from being double counted at the custodian's vault, since multiple fund houses use the same custodian?
Yeah, so we have so given that there are two custodians there in gold. One is one that actually has the vaults, which is Brinks, and second one is Deutsche Bank, which is again a custodian uh, of gold, which has sub custody with Brinks. So there are two custodians that have these gold bars. Given that Deutsche Bank now acts as the custodian for all gold funds, they have list of all the fund houses or all the gold bars held by each of these fund houses. And therefore, in their system, if there is a duplication, that gets caught, firstly. Plus, we get a detailed gold bar list from the custodian every month. And therefore, when we go, we see where our gold is segregated, what are the gold bars that it has, and we match it with the numbers that we have. And what we also do is, whenever there is a redemption and we have to sell gold, we give that gold bar number to the custodian, that this is the gold bar that has to go out. They cannot choose it on their own that what gold bar goes out. And therefore, we kind of reconcile backward in a way, and that tells us that our gold bars are unique. So this custodian level check and the check that we have shows that the gold bars we have are unique and not duplication across fund houses.
So Chirag, what happens if the custodian defaults?
The gold held by the fund is not the custodian's gold. It is owned by the trust. So custodian default will not impact, because there is physical gold firstly, and second, the gold is not owned by the custodian. They are just a safekeeper of gold, and gold held is by the trust, the mutual fund trust. And therefore, even in the insurance, it is not the custodian's name. It is said to be owned by the fund house. So from that perspective, even if the custodian defaults, they are just the safekeepers and not the owners of gold.
Right. Chirag, are you required by regulation to maintain 100% of your gold in physical gold, or is there a non-physical gold holdings as well?
So SEBI allows fund houses to have a derivative position, but we do not take any derivative position in gold. There is a separate policy. If the fund house wants to opt, they have to frame a separate policy for that. We haven't even ventured out in that way. We want all the gold in the fund to be physically backed, and therefore we will ensure that the gold that we have is physically backed and not any other kind, not a derivative or we haven't even gone towards things like gold deposit scheme where we can deposit gold with some bank and earn some interest, because that changes the characteristics of gold. Gold is no one else's liability. When you give it to a bank, it becomes a liability on that bank, and therefore we don't want to change that characteristics of gold, and therefore all the gold that we have is only physical gold.
Sure. Uh, Chirag, if a vaccine on COVID-19 is successful, how will it impact gold prices?
So if a vaccine comes out and that may lead to recovery, but what we have seen is central banks have gone beyond. Like if you see the rapid price in gold that we have seen, because gold was underpriced in a way, because central banks have done more than what was justifiable gold price level, and therefore we have seen a rapid increase in gold over last 1 year, and especially after COVID, right? Because that is where they significantly increase their accommodative stance and increase their money printing. So from that perspective, gold was looking underpriced, and that is why we have seen a big jump in gold prices over the last couple of months. So even if a vaccine comes out, I think central bank, given the damage that it has done to the economy, central banks will continue to remain accommodative to support the economy, and therefore, even from that perspective, gold price should inch upwards. But if it comes sooner, then the upsides may, to some extent, get limited. Uh, but it will all depend on how the central bank stance changes because of that, and that will determine where the gold price goes. But we don't see, even if that were to happen, the downsides on gold look limited, because to some extent central banks, as I've said, have done unprecedented amounts of money printing, and our view remains that they will continue to remain accommodative despite things start to open up.
Sure. Since sovereign gold bonds are not backed by physical gold, what is the purpose of the government to issue these funds? Is it another way to just raise money?
So sovereign gold bond idea was born when when the government was facing a significant current account deficit, and we had significant gold imports during that time because rupee was depreciating, gold prices were moving higher, and therefore government said, how could we address this? And therefore they said, let's do a sovereign gold bond, and there may be investors who will not buy gold and buy sovereign gold bond, and therefore imports of gold will come down, and that will help the current account deficit. So that was where the idea of sovereign gold bond came, because government, without realizing that that could be, if gold prices go up significantly, that could be a much larger cost to them, rather than running a high current account deficit, because the impact of current account deficit may not be so much, and at times when gold prices really go high. So that is where they had an idea of sovereign gold bond, but according to me, it's not succeeded in the endeavor that they wanted. I know people from the industry or experts in the gold field were estimating that even just in first year it will have 15,000 crores. That was an estimate that government had. That will get filled in just about a month, a couple of months of issuance. But so far, over last many years, they have been issuing sovereign gold bonds. it has only touched about 7-8 thousand crores. So that's a significantly underachievement to what many were envisaging, and therefore that idea has not resulted in the way they thought it would. So mainly, to keep it short, it was done because government wanted to reduce the current account deficit by reducing gold imports. But I think the idea has not appealed to gold investors in a big way.
Sure. Chirag, is there a plan to offer a silver ETF? Silver is giving better returns compared to gold of late.
That silver returns, I think, are better over last just 1 month or 2 months when there is a rebound in risk assets that we have seen. But otherwise, if you see long time periods, silver has underperformed gold. If you see the ratio of gold to silver, we used to hover around 30 to 40. That ratio has now moved above 100. So that really tells you that silver has significantly underperformed gold over long time period. Silver, if you should understand that post getting delinked as a form of money is more of an industrial commodity. About 70% of silver use is coming from industrial uses. The silver is like half copper, half gold. So whenever industrial activity picks up, when copper prices does well, when economy does well, silver will get stretched in that direction. Whenever gold prices does well, it will get some flavor, and especially when there is a significant rally and rally matures, that is when the speculative fervor of silver will pick up and people will move into silver because that's a cheap cousin of gold. But otherwise, it kind of doesn't deliver that portfolio diversification that gold does. We have seen whenever stock markets fall, given that silver is linked as an industrial commodity, it falls along with that, and gold usually moves in the opposite direction, gold's up. So gold is a better diversification, better allocation of your portfolio. Silver gives you similar risk return characteristics that your risk assets will to an extent give you. It doesn't help you diversify. So my advice or my recommendation to investors is don't look at silver. That could be some element of your speculative play if you like the demand supply dynamics of gold. But otherwise, from a portfolio perspective, you're better suited with an allocation to gold and not silver.
Sure. Chirag, how is marking to market done on a daily basis in the ETF? What benchmark rates are used?
So SEBI has given us a formula to derive at the gold value on each day. For gold prices, we use the London AM fixed price, which is kind of a benchmark price globally. And for rupee, we use the RBI reference rate as the benchmark price. So two elements that help determine the gold price: gold rate and rupee. Gold, we use the London AM fixed price, which comes at about 3 o'clock roughly, 3 to 3:15 in that time frame, and the RBI reference rate, which comes at about 12 o'clock every day. So these are the two prices that we use for valuing the gold. Plus, we add whatever custom duty, whatever GST, that is taxes and levies, and arrive at the Indian gold price. And that gold price is used to value the gold held by the fund.
All right. Besides investing in domestic gold funds, would it be advisable to invest in international gold funds too, given the uncertainty of COVID-19?
So international gold funds, I'm assuming that you're referring to gold mining stock funds, right? That own gold mining companies. As I have spoken before, that gold mining companies are stocks first, gold second. We have seen many times when when stock markets fall, these gold mining companies fall along with that, whereas gold usually moves in the opposite direction, and therefore they don't help your portfolio as gold would. I have seen long-term returns of these gold mining funds vis-a-vis gold funds, pure gold funds, and I've seen either the returns are comparable or most of the times these mining companies continue to lag. See, one thing you need to keep in mind is gold mining discoveries are becoming less and less each every year. There are no big gold mining discoveries happening, and therefore these mining companies, for growth, they are dependent on acquiring other firms. And when gold prices are doing well, this M&A activity really picks up, and they end up paying exorbitant price because they are compelled by stock markets to show growth. And therefore, uh, these gold mining companies do not end up living to their expectations of a leveraged gold play as such, right? And therefore, if you can time it well in terms of getting in and getting out, you may see over a short time period a higher return in these gold mining companies. At those times, they may give you that leverage return. But if you are a buy and hold investor, you want to allocate to gold for a long term, I think gold funds are better suited. They kind of give you that similar kind of returns and at a much lower risk, because gold mining companies we have seen at times, they are significantly much more volatile than what gold prices are. So from an allocation perspective, I will still recommend that you be with a pure gold play as compared to the gold mining play.
Sure. Chirag, why is there a lag in returns between gold price in INR and QGSF?
So I don't think there is any lag. If you see the domestic price of gold over last 1 year are up by 40.2%, and the scheme returns, the QGSF returns are 41.36. Even on a 3-year basis, we have seen similar returns. The differential being expense ratio. So sometimes what happens is, or if you're referring to a recent episode during COVID, what happened was gold in Indian markets, there was no new gold import happening because flights were shut. So whatever inventory that India had during that time started to go at a premium because demand for gold was increasing. And therefore that premium actually translated to a higher return, higher return of QGSF than the domestic gold price, or than the M6 price that most investors refer to, because that is what people see on TV channels or newspapers. That M6 price was trading at a discount to what the gold rate should be for India, and quantum gold saving fund or quantum gold ETF was trading at a premium because the domestic physical market was at a premium at that time. So we had three prices prevailing at that time: physical gold trading at a premium, then the parity rate, and we had M6 prices which are trading at a discount to the parity rate. And that is what investors ended up comparing, and we have written a detailed note on that explaining why that anomaly occurred. But if you see today, almost all prices are at parity. There is no premium, there is no discount. Almost everything is close to parity rates. So I agree that there was an anomaly in the gold markets when COVID hit us in month of March and April. But post May, where as imposed eased out, this is not a concern anymore. Everything has returned to par.
Okay. Is there? Can you throw some light on the taxation of gold ETF units?
Yes, certainly. The gold ETFs, as per taxation, are taxed like a debt fund. So it will have up to 3 years, it will be taxed at your marginal tax rates, whatever tax bracket you are in, that same tax rate will be applied. And if it is above 3 years, you get the indexation benefit. So it is 20% with indexation after 3 years. So if you apply the indexation benefit, we have seen over last many years, your tax rate comes to below 10%. It roughly is somewhere between 8 to 10% if you apply the indexation benefit. So that's the tax that you will have to pay when you exit the gold fund.
All right. You mentioned that the quantum gold fund is 0.05% more expensive than the ETF, but ETF purchases by retail investors will invite brokerage charges of at least 0.3%. So isn't it always better to buy the fund rather than the ETF?
I would agree to that. That gold fund kind of helps you in terms of the brokerage differential, because at a retail level, as you have highlighted, I think it's 0.3% at the minimum. Whereas if you were to look at what brokerage we pay, it's closer to 0.12%. So there is indeed a differential between the brokerage rates, and that's helpful for the investors. And secondly, we've been following the gold market very closely. We will not end up paying a high price when we buy, or we will always pay a market price that is prevailing at that point in time. So also from that perspective, the investor ends up buying in a more efficient way. So on both counts, I think I'll agree that the quantum gold saving fund is a better way for investors to buy.
Hmm. Um, Considering that societal behavior in India towards gold is changing, and we are seeing people wearing less, the younger generation wearing less gold, will this affect the demand for gold in future?
I think indeed for jewelry, I think there we are seeing a sea change in investors' behavior towards jewelry, buying jewelry. Most are buying lightweighted jewelry. But recently, I was speaking to a jeweler, and the insights that he gave me that people are, although preferring a lightweight jewelry or not going for that loaded jewelry, but they are preferring various investment forms of gold, and that shift we are certainly seeing. And time and again, I have seen, be it the 2008 crisis or be it the COVID crisis, people have moved or understood the importance of having gold in their portfolio, and therefore allocating it from that perspective. People are kind of moving towards a 10 to 15% allocation to gold. And also we have seen advisors advise investors in a more prominent manner, saying that you need to have an allocation to gold. So with each passing crisis, we have seen the increase, the approach towards investing in gold is going up, and the jewelry is going down. So we are seeing that change happen, and I think that is where the efficient forms of buying gold are coming into picture, and people are adopting that in a bigger way. And now certainly investors are demarking what is for consumption and what is for investment. What is for consumption is always going to be jewelry. You cannot replace that. But when it comes to investment, people are certainly moving towards more efficient forms of purchases.
Sure. Um, China and Russia are holding the highest amount of gold. How will this impact global gold prices in global currencies going ahead?
Sorry, can you repeat that?
Sure. China and Russia are holding the highest amount of gold. How will this impact global gold prices in global currencies going forward?
Yeah, so certainly we are seeing many countries having an approach towards building their gold reserves, like especially like China and Russia. And if you see, they are moving away from US dollar dominance in a way. So wherever we have seen these countries where they don't want to be threatened by dollar dominance, or where we've seen sanctions by US towards these countries, we have seen significant increase in reserves in gold and moving away from US dollar as a reserve. So I think that trend is going to continue. We think that diversification of reserves at the central bank level uh, towards increase in gold is going to be there or will continue. Even we have seen India also increase, timely increase their allocations to gold. Like in 2000, if I'm not wrong, 2011, they sorry 2009 they bought 200 tons of gold. Even recently last year they increased their gold allocation. So overall we are seeing that trend where countries kind of trying to increase their allocations towards gold and lessening their reliance on US dollar. Even from a trade perspective, we have seen that change. It's still very subtle change, not a very significant change, but we are seeing a move in that direction, that trade reliance on the dollar is going down and people are moving to bilateral trades, and also at the same time they are increasing the allocations to gold.
Sure. Next question. Given current prices, is Quantum buying gold at these rates, or is preferring to wait for a lower price?
No, we do not time gold markets. Whenever we have investors buying our gold units, there is equivalent amount of gold being bought. So we do not time gold markets or wait for better prices. Whatever gold inflows we get, we will buy equal amount of gold at that time. One thing that I would highlight is to give our view on gold is in our multi-asset fund, we have increased our allocation to gold. So if the prospects of gold are looking better, so we have reduced our allocation to equities given the run up in equities there, which we have seen, which looking disconnected. And at the same time, we have increased our exposure in debt to our liquid fund and to our gold fund. So if one is trying to gauge what is our view on gold and where we are investing, that gives you a flavor of that.
So that brings me to the next question. Why does the Quantum Multi-Asset Fund hold Quantum Gold ETF and not the Quantum Gold Savings Fund?
Sure. Given that the multi-asset fund is a fund of funds, it invests in our other quantum funds to gain the asset class exposure. One fund of fund, as per regulation, cannot invest in another fund of funds, and therefore we invest in the gold ETF and not the gold saving fund, because gold saving fund is also a fund of funds. I think Malay can add maybe more on that from a regulatory perspective.
Yes, yeah. What you say is correctly right thing. So one fund of fund scheme cannot invest in the other fund of fund schemes.
Thanks, Malay. Thanks, Chirag. Next question for you, Chirag. I understand the gold savings fund invests in the gold ETF, but I see that the expense ratio of savings fund is lesser than the ETF. Am I right? And what is the reason for that?
So whenever you invest in a gold saving fund, there are two levels of expenses that you end up directly and indirectly paying. One is direct expense ratio of the quantum gold saving fund, which is 0.05%. And what is, because it owns the quantum gold ETF, so you indirectly pay the expense ratio of the quantum gold ETF as well, which is 0.97%. So in a gold ETF, you will end up paying 0.97% as the expense ratio, whereas in the quantum gold saving fund, you will end up paying 1.03% as the expense ratio. So that is the differential. It's not that the quantum gold saving fund has a lower expense ratio. In absolute basis, it is. But directly, you need to consider both direct and indirect expense ratios that you are paying. And in totality, the quantum gold saving fund expense ratio is higher than the quantum gold ETF.
Interesting question here, Chirag. Is it a good time to invest in gold, or is it better to go for the ESG fund?
So I think both have a different purpose, a different mandate, and different role in your portfolio. So as I have explained, why you should allocate to gold, and ESG fund is more an equity product. So if you want equity exposure, you should be in the ESG fund, and if you want to be in gold, you need to be in the gold fund. So I will say you should invest in both essentially. And if you're investing in ESG fund, you should definitely have an allocation to the gold fund. So I will put it that way. But if you have to choose at this juncture, given that it is an equity offering, I will say that you slowly increase allocation towards equity whenever you get opportunity in equity markets or through an SIP or STP. Whereas gold, you could buy it right now, given the prospects of gold look much better. Or else, even in gold, anytime there will be volatility in asset classes because central banks are intervening in an unprecedented manner. which will also spill over into gold markets. So maybe you could have a 6 to 12 month SIP allocation in gold and build your exposure. Uh, because both have a different mandate, you should determine what kind of allocation you are looking for. If you're looking at an equity product, you could look at the three funds that we have in the equity offering: the long-term equity fund, the equity fund of funds, and the ESG fund. And if you're looking for a gold exposure, it's either be gold ETF or the gold saving fund.
All right. Chirag, what should be the ideal period of holding gold?
See, gold is an allocation, and therefore I would suggest that you need to have an allocation at all times, especially when you have a depreciating rupee. That really helps, and also given that time and again we have seen significant losses in equity markets, it also helps during those times. So I think if you have an allocation across asset classes, gold has to be an allocation at all times. A 10 to 15% allocation is what we would recommend, because we have done a study from 1990 till today, and we have seen an allocation of 10 to 15% is an ideal, because at that level of allocation, gold adds to returns of a portfolio and reduces your risk. As you know, everything has a marginal utility, like the marginal utility function that we have, that beyond a point, adding something doesn't add to the value, it kind of diminishes in value. Similarly, above 15% allocation to gold kind of diminishes its value addition to a portfolio. And therefore, a 10 to 15% allocation is an ideal allocation that you should have. And I think that should always stay. At many times, you'll see gold perform well. At those times, if your allocation stays 15% has gone to 20%, you could trim that allocation from 20 to 15, again back to 15. But you need to have an allocation. There will be periods where you rebalance your portfolio and you book your profits and go into other asset classes which are not done well. That is fine. But you need to have a 10 to 15% allocation at all times.
Thanks, Chirag. What is your opinion on ETF versus sovereign bonds versus gold from jewelers?
Okay.
This one's going to be a long answer.
Yeah, absolutely. So gold ETF gives you an efficient price exposure to gold. You don't have to worry about the hassles of physical gold. You don't have to worry about purity. It's all been taken care by the fund house. It gives you wholesale prices at lower denominations. So those are the plus points of the gold funds. Sovereign gold bond gives you that gold price exposure for sure, because it is guaranteed that by the government that you will get the gold prices. They will even pay you interest, but it is just a gold price exposure. It is not backed by physical gold, right? So as the slide that we have comparing all three forms, uh, uh, one thing about sovereign gold bond is that people buy gold because they don't trust the system. And with the sovereign gold bond, you're buying gold from the same system. And therefore, you're changing the characteristics of gold in a way. Gold is no one else's liability. You're making it a liability, though it is government, but it's still a liability of the government. You're banking on the government to make good on the liability that they have. So from a return perspective, yes, sovereign gold bond may give you better return, but again, you need to understand what is the gold that you're buying. And gold from jewelers, again, we have seen time and again, there have been cases of impure gold that you end up having. There are significant markups that you pay when you buy from jewelers, because they have to run the showrooms, the staff that they have, the rentals that they need to pay, all come on you as a buyer of that gold, right? And whenever you sell gold, there are again discounts, there are again low resale value, because they take melting charges from you. You don't get the same gold rate. So all those are problems when you buy gold through a jeweler. I think when you are looking at investment in gold, Jewelry is the most inefficient form of buying gold. Whenever you want for consumption, there is no other choice than jewelry. But when it comes to investment, it cannot be jewelry at all, because you are doing yourself a big disfavor. Whatever returns you are going to get in gold, you are just losing out if you're buying jewelry, because there is significant markups, purity concerns, lower purity, lower resale value, all that comes with gold jewelry. So please demark what you're buying gold for, consumption or investment. And when it comes to investment, I think if you want pure gold exposure, it has to be gold ETFs or gold funds that will provide you that.
Chirag, is the wholesale selling price of gold that is used by ETF, it's much less compared to the retail selling price? Are there wholesale price benefits when it comes to the ETF?
Definitely, there are wholesale price benefits. So what happens is at the retail level, when you buy, you pay higher than what the gold price is. When you sell, you get lower gold price than what it is. When it comes to wholesale gold, you're paying what the gold price is, and when you sell, you're getting what the gold price is. So definitely there is a difference. When you buy at the retail level, you lose at both ends. Whereas in wholesale market, when we participate, it is indeed a very liquid market, and therefore you don't benefit when you buy, you don't lose out when you sell.
All right. So Warren Buffett has been quoted very often saying that gold does not have any earning power. It doesn't earn interest or dividends. So what is your view on that?
So I think Warren Buffett has never lived in a developing country like India, where rupee always tends to go southwards. We have seen that the chart, we have seen that rupee over long time period has depreciated by 5% per annum, right? That is not what he has seen in America, right? Because dollar is appreciating vis-a-vis other currencies, and therefore he doesn't understand where we are coming from and why we love gold so much, right? People are buying gold because of the debasement that they're seeing in the rupee, in a way. And therefore, I think Mr. Buffett, all respect to him, will change his view when he comes and lives in India, and probably he may not understand our perspective when he stays in US. So that is the big difference between. Though gold doesn't give any returns in terms of interest or dividends, we have seen gold preserve purchasing power over long time periods. Many of these fixed income instruments that give you interest, many of times they give you negative real rates because inflation is higher, like the chart we have. Like, I will just show you that chart, which is indeed an eye opener. Fixed deposit, the thing highlighted in yellow, has given you significantly lower returns than the inflation, and therefore fixed income instrument, though gives interest, has been a big losing proposition for Indian investors. Whereas gold has done much better despite not giving you returns as interest or dividends. And that really tells you that rather than being in fixed deposits, you would have been better in gold. So that story really tells you that gold is an asset that preserves your purchasing power, and that is a really useful trait when it comes to your investment.
Chirag, recently there was a huge variance between the prices of gold ETFs and their NAVs.
Right.
Could you please throw some light on why those prices were trading at a premium or discount to the NAV?
Sure, absolutely. So we have seen that after COVID, and as you know, that most of the gold in India is imported from overseas. We do not produce any gold. There is some scrap refining that happens, but that's just that. Most of the gold in India is imported, and therefore, when flights were shut, no new gold could come into India, right? It was literally shut for about a month because no new flights were coming in. And therefore, whatever inventory was lying in India with banks, with institutions, was the only inventory that was getting priced. And we had seen a sharp pickup in demand for gold, for things like gold ETFs or gold funds, uh, and that led to a premium market. Given that you had constrained supply and higher demand, that led to a premium in gold, and which translated into a differential. That NAV is a theoretical price. NAV is derived at a London AM price, and a rupee rate doesn't incorporate premiums or discounts, and therefore NAV was where it was at the gold price parity level. Whereas given that supply constraint that we were seeing, the gold was at a premium at about 2 to 3%, and sometimes and at times it had shot up to about 4%. So that constrained supply, as it eased out, that premiums collapsed, and that was the anomaly that we are seeing in the gold market. There was no issues because the physical market was trading at that level. You could buy at that price, at that premium level. You could sell at that price. So those were not manipulated prices. Those were the real prices, real transactable prices. And when that premiums went off because supply started coming in, flights were allowed, and therefore you saw that gold imports coming in and premiums disappear. So that was the phase that we had seen over last couple of months. But now, if you see, it's come to parity rates. Gold prices or gold funds or gold ETFs are trading at nearly the NAV levels, and all physical market is at parity levels. So the anomaly was a short-lived anomaly for a fraction of time, for a couple of months, but now it has ironed out.
Sure, Chirag. Last couple of questions. It is predicted that the world is going to go into a recession. So how attractive is it going to be to hold gold for the next 2 years?
Certainly, there are all predictions forecasting for a recession this year. It's almost a recession kind of scenario. So indeed, during such times, we have seen the central bank's response has always been accommodative. They print a lot of money. They have always sought an easy answer to paper over the problems. They print more currencies, and therefore they think that the problem is being taken care of. What they end up doing is just kick the can down the road. The problem just postpones, and therefore we stare up at another crisis. Whenever they try to withdraw from the market just gives up. And therefore, I think that this is a great time to to have an allocation to gold, because certainly these central banks, as I said, that even after global financial crisis, they remain accommodative and were printing money for 6 years after that. This is a much bigger crisis. The magnitude of the crisis is much larger, and therefore they will continue to do a lot more than what we have seen. They've already tried to preload or do it much more aggressively this time. And my sense is that they will continue to keep that accommodative stance and keep printing money for a fairly long time, at least for next couple of years. That perspective, debasement of currencies, real interest rates staying low or to negative, risk of stock markets going down because it's been fairly disconnected from what the reality is. All these pointers tell me that I need to have an allocation to gold. Gold prices look good, constructive, positive going from here, and so please have an allocation to gold. If you don't have any allocation to gold, buy 50% right now. Rest 50% you can stagger it over next 6 months, 12 months. If you have an allocation to gold, stay with that allocation. Do not look at booking profits, because it looks a must essential element at this juncture. And if you have lower allocation than what you intend, then depending on what you have, you could keep increasing your allocation, look at any opportunities, because as I've said, there will be volatility in financial markets as central banks intervene at unprecedented scale. that volatility will translate to gold market volatility. It won't go in a straight line. So any opportunities that you see, you should kind of grab that opportunities, because downsides limited in gold, and the view looks more positive and constructive.
So Chirag, what would be your suggestion to an investor who is worried about something like what happened in China happening in India? What is that one takeaway you would give to him? And I also request you to give your closing remarks with this question.
Sure. If you're investing, I cannot say about other fund houses or what policies that they have or other products that are there, but I can surely tell you about what policies we have in the quantum gold ETF. We surely got your back here. We certainly go beyond what you could even think in terms of safeguarding your gold that we have, because it is our fiduciary duty at the end of the day to ensure that your investments remain protected and be pure to what you have bought. So gold should be indeed gold, and that is what we'll ensure at all times. Whatever new things that we have to do towards safeguarding of your gold, we will continue to do that, adopt that, and therefore have an allocation to gold. It's indeed an essential element of your portfolio. And in terms of safeguarding, leave it rest to us. We will ensure that gold you bought with us is indeed pure and is indeed gold.
Thank you, Chirag. You have very patiently answered a large variety of questions on gold over the last 1 hour. So thank you so much. Again, special thanks to Malay for being here and personally assuring our investors about the purity of gold at Quantum. We hope Chirag answered all your queries, and we have been able to assure you of the purity of gold that you will be investing in when you choose Quantum Gold ETF. So thank you again, everyone, for attending. We will be back with more such sessions. Good evening. Thank you. Closing the session now.
Thank you.
Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.